The US economy has experienced two significant changes in the past 2 months. The momentum lost in the September quarter because of Delta has been regained, and the scale, breadth and expectation of inflation has risen to multi-decade highs. We consequently expect a material shift in the committee's approach to policy at the December 14-15 FOMC meeting, with the pace of tapering to double to conclude purchases in March 22, 3 months earlier than currently planned. Doing so will make room for 3 25 basis point rate hikes in 2022 at the June, September and December meetings. It is important to highlight that this policy change is not expected to occur out of fear of inflation. Instead, it is the result of a careful assessment of the spectrum of risks the US economy faces. With respect to activity, the threat from Delta looks to be subsiding, with rebounding consumption and robust investment growth pointing to growth at a multiple of potential in Q4, as well as the first half of 2022. Further, the run of weak readings for employment through Q3 have largely been revised away, and current job creation is more than enough to see the economy tend towards full employment in late 2022. The prime risk for activity in coming months is arguably that labour demand runs too far ahead of supply, while participation remains weak, creating wage gains at odds with productivity and additional fuel for already elevated inflation expectations. These are circumstances that could turn a transitory period of high inflation into a persistent force difficult to control without a material cost to the economy. Although by last week the market had moved to price in a first rate hike just a month after the current end of the taper in June 2022, we do not believe such a quick turn is likely, given tapering is not tightening and the economic threshold for tightening, that is raising rates, has always been much higher. A 3-month pause for policy from March to June 2022 is most likely, to be followed by 2 further 25 basis point increases in September and December as the US economy continues to grow above trend and rising participation allows maximum employment to converge with full employment. From June 2023 to June 2024, we see one rate hike every 6 months, to a peak federal funds rate of 1.625%, which is unchanged from our prior call. This unchanged endpoint highlights our belief that while inflation risks are presently rife, prudent policy and the passage of time will see them abate. Our expectation that economic growth can settle at trend with full employment is also behind our view that the US 10-year yield will hold above the federal funds rate over the entire forecast period, only retreating from a peak of 2.3% at September 2022 to 2.2% end 2023 and 2% at end 2024, as inflation and hence rate risks abate. This dynamic, risk-aware policy making by the FOMC is also expected to keep the US dollar in a tight range on a DXY basis over the forecast period. While divergent rate expectations and risks related to COVID-19 are set to weaken the euro to June 2022, once the first hike is delivered by the FOMC and prospects for Europe and the global economy strengthen, the US dollar DXY index is forecast to ease back 1% from mid to late 2022 and another 2.5% by end 2024. Underlying this result is not only the market's confidence in the FOMC's ability to deliver GDP growth sustainably at trend without undue inflation risks, but also a view that the global economy will continue to strengthen over the period, reducing the US dollar's value as a safe haven. To the above view, the ongoing spread of Delta in the US and the nascent and largely unknown threat of Omicron are pressing risks. If either variant of COVID-19 destabilises US growth prospects, the committee can delay any move to accelerate the taper and/or increase interest rates. However, we must recognise that the spread of either variant could accentuate supply issues currently pressuring US inflation and real incomes. Absent a material hit to growth, such an outcome would provide further justification to move away from current emergency policy settings to better match short-term demand and supply, and therefore maximise the cumulative return from this growth cycle. The FOMC can and will continue to adjust policy to suit current and anticipated conditions, giving confidence to markets and the global economy. We'll see you next time.